Hello, everyone. My name is Cole DeLucas, one of the financial planners on the team, and I want to thank you for taking the time out of your day to spend a few minutes with us as we kick off the beginning of a new video series where we will explore a few different topics within personal finance. There are a few popular topics within personal finance that we are constantly discussing with our clients, and we plan to touch on a few of them in the coming months through videos such as this one to share our expertise. We hope you find this information interesting. And if you ever have any questions as you are digesting these videos, please do not hesitate to reach out. And so with that being said, why don't we jump in with today's discussion? We'd like to start with a brief overview. So what is personal finance? This illustration in front of you is how we envision personal finance. As you can see, it has a lot of moving parts, but in a way, all the components you see here in this word cloud have to speak to one another in order to not only be an effective, but an efficient financial plan. And that's our job. We spend a lot of time working with our clients on an everyday basis, diving deeper into these topics and making sure the various pieces of their financial plan are working together in service of the client's goals. Another thing I will say in this same vein is if there is one thing that bleeds throughout all of personal finance and influences every moving part, it is cash flow. And you will notice how it is at the forefront of everything we discuss in this video series. So given that quick overview of personal finance, I want to share the various topics we plan to review in our video series. The first being, which we will cover today, is employer-provided benefits such as 401k plans and company-provided insurance coverage. Number two, cash flow planning and the value it brings to one's financial plan. Third, policy-based financial planning, and I will define exactly what that is. And lastly, we'll spend some time answering various questions we receive from clients on a day-to-day basis that cover an array of subjects within personal finance. So with the remaining time that we have today, we're going to dive into numerous employer-provided benefits and how to maximize their value as an individual in the workforce. The goal of participating in employer-provided retirement plans is to best optimize the use of the dollars you earn with these different investment accounts you see on your screen. Most employers offer the opportunity to contribute to a traditional 401k or a Roth 401k. So with that in mind and keeping our clients' cash flow in mind, the first thing we are thinking about is how do we take advantage of one of the unique benefits provided by employer retirement plans, and that is free money. There is a strong advantage to contributing to an employer-provided plan because there is usually an employer match if you contribute to that plan, and sometimes beyond a certain threshold. We want to ensure our clients contribute enough to get that company match, and we want them to match their contribution to the plan. And that is all provided that within the context that their contribution is at a level that works within that client's cash flow. So how do I decide which plan to contribute to between a traditional 401k and a Roth 401k? Deciding whether you should contribute to a Roth 401k versus a traditional 401k in part depends on the amount you are earning now and what you may be earning in the future because of how the accounts are treated from a tax standpoint. We make the recommendation on a case-by-case basis depending on your income expectations. Moving along, next are the HSA and the FSA options, which are accounts you can take advantage of to reduce your taxes as you contribute to the account's pre-tax. And also, there are no income limitations on contributing to either account. A HSA is to be used for qualified medical expenses at any time, and the account balance can transfer over the preceding years. Essentially, you can contribute to an HSA up until your age 65, which is when you are eligible for Medicare. You can withdraw and use the funds for expenses tax-free, as long as they are qualified medical expenses. And for contributions, you can contribute up to $3,650 to an HSA as an individual, or up to $7,300 for families in one calendar year. Then there is the FSA option, and that has two components, and it does act differently than an HSA. There is an FSA for healthcare expenses and an FSA for dependent care expenses. Let's start with the healthcare piece. An individual can contribute up to $2,850 in 2022. Those dollars are pre-taxed and can be used on qualified medical expenses. The dependent care option can be used for child expenses up until that child is age 13. For example, that might be daycare. And an individual can contribute up to $2,500 if they file as an individual, or $5,000 can be contributed if they're filing a joint return. Now, the big caveat between the two accounts is with an HSA, you can keep it forever, and the balance continues to roll over year after year. But with a FSA, it is coined the use it or lose it account, meaning if you do not use the funds that you contributed in that calendar year, then the balance is forfeited for that year. So be mindful of the dollars you contribute if you're using an FSA. Lastly, there is also an opportunity for an employee to receive certain insurance coverages through their employer. And you can either split that cost with your employer or maybe even get the coverages paid for from a premium standpoint. We generally recommend, if insurance is an option through your employer, that we encourage you to enroll in those because it can be much cheaper than buying a private policy. Now, if you have dependents, we generally recommend enrolling in as much life insurance as you need through your employer to save on premium expenses. Likewise, for disability insurance, we generally recommend maxing your coverage up to the amounts provided for both short-term and long-term disability coverage. And that is regardless of whether you have dependents for disability. Finally, we spend time reviewing the various healthcare coverage options with our clients to help them choose the plan that best fits their needs. Now, with all that being said, you may find that additional insurance is needed on top of which is provided by your employer, given your particular financial situation. And that is when we help you determine what additional coverage you need to be adequately insured, and we connect you with a broker, of course. And with that, that concludes today's first video. We hope you found the content helpful and interesting, and we'll see you back here in a few weeks to dive into part 2 of our personal finance video series. Thank you for joining.